Good afternoon, everyone, and welcome to another fabulous edition of I-10 Second Thursday at Venture Cafe Virtual. We do programming here on the second Thursday of every month, ever since Venture Cafe opened in the fall of 2014. And we're actually doing one on the third Thursday because we're that crazy this month. So we'll have another event next week, but this week we're talking about equity. So I'll let Connie introduce our speaker, and thank you everyone for attending, and we'll see you next week and next month.
So I'm Connie Gallagher. I'm the Business Development Manager at I-10, and I'm happy to introduce our host today, Mark Graffagnini, and he is the Managing Partner of Cara. Cara is a national law firm focused on transitional law, securities, and corporate financing. And since leaving Silicon Valley and returning to his hometown of New Orleans to find Cara, Mark has successfully advised clients through various rounds of financing, exits, corporate governance, and fundraising strategy. And then over the last 10 years, Mark has led hundreds of financing transactions from seed rounds to IPOs, and the companies Cara has worked with have returned over $600 million to investors. In addition to his role at Cara, Mark is also a partner in Calais Capital Ventures, a Series A venture capital firm where he is responsible for sourcing, screening, conducting diligence, negotiating, and advising portfolio company management. So we welcome Mark, and Mark, I'm going to just turn it over to you and you can take it away.
Right, thank you. Hello, everybody. I see some familiar names, and I wish I could be there in person to see everybody at Venture Cafe, but I'm glad that you joined, and I know that based on the people that I see that are here attending today, I should get some good questions to stump me. So I'm looking forward to some good dialogue. And today we're talking about what is the better deal, convertible note or SAFE versus equity round. And I think that this has become a real issue of discussion among people in the venture capital industry, mentors at accelerators, founders. And I'd like to give you a little bit of my perspective, which might be somewhat different than the conventional perspective that you hear on this stuff. And as Connie mentioned, I basically got started in venture capital in around 2004 or so. And I had gone to college in California. I had started a law and business journal focused on nanotechnology with a bunch of people in Silicon Valley. I ended up practicing at the largest law firm out there, a firm called Wilson Sonsini, where I did everything from early venture and angel pre-seed deals through the IPO public company representation process. And then as everyone mentioned, I moved back home to New Orleans primarily about 10 years ago, and I started doing this under a firm that I created. And since then, we've become one of the more active groups, I think, in the space in the central US. So we've done hundreds of deals, over $1 billion of venture and angel capital transactions in that time. And it's actually been about $1 billion plus in exits. So in 2018, for example, I took a company called Waiter Public, which is a mobile food delivery app based in the Southeast. That was one of the largest non-Silicon Valley tech transaction IPOs that year. It's my fundamental belief that the future of innovation and really good exits belongs to places outside of the East and West Coast. And I think that there's a lot of exciting things that are happening in these markets. And one of my passions in life is helping to put some data and metrics around what's going on in these other markets, because a lot of what people read in blogs and a lot of the information they access sometimes concerns what's happening in places that aren't necessarily applicable in other markets. And as mentioned, one of the more fun things that's happened in the last year is that I've been company side primarily through most of my career, helping companies navigate the issues with venture capital financings. And now I've been fortunate enough to join a fund where we're investing $1 to $2 million checks in Series A deals. And typically we're looking at companies that are doing $1 million or more in annual recurring revenue. And I get to have a different perspective that's also informed kind of my thoughts about these different things. And so, the topic today, as I mentioned, are really our convertible instruments, things like convertible notes or safes, simple agreements for future equity. Are those things good or bad? And the answer to that question, like most things in life, is it kind of depends. But I'll tell you some things that I've found throughout my career. So the number one reason that people cite to me when they're starting a fundraising especially at an early stage level, like a seed or pre-seed level, is people say, well, I want to do a convertible note or a SAFE because, we're just going to grow so much between now and the time I do my Series A. It's impossible to peg a valuation at this point. And I don't want to harm myself by putting it too low and doing an equity round. And I'll say that this is really a new development, relatively speaking, in the history of venture capital. So like I said, I've been doing this for almost 15 years now. And historically, notes and safes were primarily used for bridge rounds, meaning like a round between a Series A and a Series B. So typically, especially in Silicon Valley when I was there, I would see a safe, or really safes weren't even done when I was there primarily, but convertible notes were typically used after a company had done a Series A and something went really well or something didn't go quite as planned. So they could be used to get a company out of trouble if it didn't hit its milestones. And the idea was that you gave something to an investor that's better than equity, that's an inducement to come in the round between that period of time, because it's a little bit more risky than maybe it was in the equity round. Conversely, if something really positive happened, like the startup got a really big customer and they needed to scale up their expenses and hiring needs and other things, then people would do a convertible note in order to get to that next milestone and then do a B at a really outsized valuation, or you could say B to C or whatever it was at the time. As the recession took place in the last recession, so from 2008 to 2009 or 10, you started seeing a lot of people get into early stage financings that weren't really there before. So one of the benefits, I think, of the last recession is that whereas most investments that I was doing on the West Coast involved established venture capital groups and some super angels, so really super high net worth individual people who were writing multiple $1 million plus checks per year, you started to see a lot of different angel groups pop up, whether they're angel networks or funds or individual angels. You saw across America an attempt to boost up mainstream to places like St. Louis and New Orleans and Tennessee, et cetera. We're really focused on building the local communities and supporting entrepreneurs and local networks. And you started to see kind of a proliferation of convertible notes. Then, if you're not aware, a group in Silicon Valley called Y Combinator, which is really in the business of incubating companies and providing a bridge between some investors and early stage companies, came out with this instrument called the Simple Agreement for Future Equity. Now, the term that I did not see a whole lot before the last recession that I started seeing after the last recession is something called a valuation cap, which is what we'll get into in the next slide. But I give some of that context and history because, again, I think when it's important as people think about what to do for their first round or their second round, and as they're evaluating their financing strategy, that they understand some of the historical context, because notes and safes really weren't typically used to minimize the valuation risk to the founder. In fact, they were used to do the opposite. They were used to incentivize in a difficult time investors to come into deals and say, look, you're going to get the benefit of interest and you have no risk that the valuation is going to be higher than what you would have negotiated with me anyway. So instead of actually being a favor to founders, really, I believe notes with valuation caps and safes, which always have valuation caps for the most part, were done as a favor to investors to induce investment by people not that familiar with the whole concept of early stage investing. And so, but nonetheless, these have taken root and they're a fundamental feature now of the early stage company landscape. So when you think about these instruments, you want to keep this in mind. And the reality is a note or a safe is not always the best deal for a company. So it's important that as you're doing these things, you want to actually do the math and model out what the conversion of this instrument is going to be in your next round. So a couple factors to consider here. Number one, I would say that in general, if you don't know, you should know that what if an investor typically buys in any given equity round is on the low end 10% of the company, and on the high end typically 33 or so percent of the company. So most investors don't want to go higher than 33%. They don't want to end up with a 40% stake in a company. They don't want investors as a block to do that. When later investors see that, they often think, well, there's something wrong with the cap table. People already own too much of the company. The founder might not be incentivized to see this through. So that's kind of a background thing to consider. So whenever you're doing a note financing round, it's important, or a SAFE, it's important that the money under that instrument that's planning to convert, that plus the new money is supposed to equal 10 to 33% of the whole company at that Series A. If you end up selling 40% or higher because of the conversion and the valuation caps plus the new money, people are going to look twice at your capital structure and think that there's a problem. And again, you shouldn't necessarily look at a convertible note or a SAFE as a financing round in and of itself. It must be looked at, because it is the nature of the instrument, as a part of a Series A. And so it's important that you understand what's a realistic valuation conversion price at the time these notes converts in order to do the calculations here. So I take it for granted here that most of the notes that I see out there in the market, of course, not for our clients, we don't typically agree to them if we can get away with it, but I see a lot of companies out there, especially as an investor, that have agreed with early stage investors to a very low valuation cap, or a valuation cap of any kind. And what I want you to consider here is that a valuation cap can and will be used against you in a negotiation for your Series A. So there's almost no investor that will look at a company at a seed stage 2 or a Series A that isn't going to look at your current instruments, your convertible notes and your safes, and they're going to look at your valuation cap and they're going to say, well, I assume that you had good advisors. I assume that you did the math and you anticipated your valuation being this number at the time you're soliciting a group like mine for investment. As an investor, I do it to people. When I'm advocating for a company, I see it done to clients all the time if they have a valuation cap in place. So one of the big reasons that people often cite for doing a note round in the first place to escape the valuation question, what I'm telling you is, if you have a valuation cap in your note, it's unlikely that that's going to happen. Instead, it will be used as a basis or a starting point for a negotiation. I think the second thing to consider and to think about is that the expectation is that your valuation cap, to protect yourself, it really has to be at a minimum equal to what your valuation is going to be in the next round, or it should be higher than what you think is reasonable. In other words, put a reach in there. Otherwise, it only works to you as a founder to your disadvantage. So why is that? Well, with a note, you're giving an investor interest. So they're already getting compensated for their money being in the form of interest, which then converts into equity later. So their money goes further automatically already. If you set a low valuation cap, it means there's absolutely no risk to the investor that their valuation is any different than yours. So it creates a little bit of a misalignment in interest. Whereas if your investors are uncapped, they still get a discount to the price per share paid in the next round. So they still get a better value for coming in early, but you might be able to convince them that a higher valuation negotiation is still in everybody's interest and that you're still aligned. The second thing that I think a lot of people don't understand is that there's something called a valuation overhang. And to understand this concept, you essentially need to understand how an equity financing works. So I think it's a mistake when founders go, I'm not going to worry about how equity financing works right now. I'm just going to worry about this note. It's way easier, because you're missing a couple of key points. So if you're familiar with a convertible note instrument or a SAFE, you're familiar with this concept of a discount price. And that's the 80%, let's say, that the note converts into of the price per share in the next round. So if you're selling shares in the next round for $1, your note investor is going to get an 80-cent per share price. Well, the way that equity documents are typically worded is that you're selling one kind of preferred stock to investors in the next round. So let's say you're selling Series A preferred stock to the investors in the next round for $1 per share. That's the new investors. Your old investors then get the same number of shares at 80 cents. So they get more shares, but then on top of that, the way that the liquidation preference, that's the money that the investor gets out of the company if you exit, is all tied to that price per share of the new money for the most part. So in other words, every investor, whether they paid 80 cents per share or they paid $1 a share, is going to get the same $1 back when the company exits. Now, you can have a lawyer negotiate what's called a shadow series of preferred stock. That would say, if you paid 80 cents per share, you get 80 cents at the exit. If you paid $1, you get $1 per share at the exit. but it starts to make your capital structure look a little bit messy. So in order to do that, you'd have to have a series A1 and a series A2. And one group gets the A1, one gets the A2. It's not that big of a deal, but it does start to make it look a little bit messy. And sometimes when you start seeing companies sell shares at different prices to different groups of investors, it makes an investor scratch their head and go, what's up with this? Either they didn't adequately determine how much money they needed, so they had to sell different things at different prices, or it just raised a red flag. I got to stick lawyers on this, or I got to stick people on my analyst team to go do diligence why this is happening. So although you can compensate for it at your Series A, it has to be negotiated, which isn't going to be a big thing that your note or safe investors want to do, and it gets a little bit messy. So even if you do compensate for the valuation overhang, it leads to a little bit of an issue before. And I would encourage you again, the idea about a valuation cap was there because people in the last recession primarily were concerned that the recession had led to a dip in valuations, which it has again this time, and that they didn't want to have a big problem in those bridge rounds for when things corrected and some of those portfolio companies were doing the next round. So again, the genesis of this was not company favorable. And if you're putting a valuation cap in your note, then you really ought to consider whether or not it makes more sense to do an equity round if your valuation cap is equal to or lower than your expected valuation in the next round. Another thing that people often overlook is you know, if as a VC, I were to go to a bunch of companies and do an equity deal, and I said, you know, at a minimum, I get 2x my investment, then that would be what's called, you know, a liquidation preference multiple. And what people oftentimes fail to realize is that a lot of convertible note deals and safe deals have what's called a change of control premium. And so what that is it's a guaranteed multiple on the investment of the investor in that deal. So a common one is anywhere from 1.5x to 2x the investment. So many investors negotiate in the context of a note that they'll get paid at least either a lot of times they'll say, I get the better deal of either 2 times my investment or whatever the valuation cap is, or, you know, a discount, and they get to elect among those things. Well, it's very rare in any equity deal these days that investors get a liquidation preference multiple. So in other words, you know, only in very rare cases, I would say, where you're doing a series B or C and there's some trouble with the company or maybe the economy, where investors are able to negotiate more than a 1x multiple. So most equity deals, and for example, if you did a Series C deal, then you would be agreeing with investors typically that they either get their money back or they get their pro rata share. So they get what's called a non-participating liquidation preference. So oftentimes on that change of control premium, it's not a better deal. In other cases, you know, you're still giving the note investors and safe investors a lot of times basically a veto right. If you don't give them a change of control right, you're essentially giving them a veto right over a transaction like that where they would get, where the company would get bought out or something. So that's another factor to consider where an equity deal might be actually better than your convertible note or safe deal. Another site that I get, or another argument in favor of a convertible note round is, or a safe round, is oftentimes that it costs less. And I'm here to tell you that if you're using a lawyer that says that a convertible note round or a safe round is materially less expensive than doing a Series Seed round, and Series Seed has template documents nationally that a lot of people use, you may want to shop around a little bit, because I don't think it's materially different in terms of cost for people that do these on a regular basis. They all have different issues. There are multiple items that get negotiated in a convertible note and safe context, and there's multiple issues that get, I mean, I think there's actually fewer issues that get negotiated oftentimes in a Series C deal than not. There might be some more filing fees. So if you have a corporation, you need to amend and restate your certificate of incorporation as part of the deal, which is what you usually have to do with an equity round. Then you might have some filing costs, but those really aren't that substantial. I think another thing that people underestimate are some benefits of other benefits on why to do an equity round, which includes, from my perspective, getting used to having true shareholders that you're supposed to keep updated on a regular basis. I don't think it's a bad idea. if you have the right people around to start forming a board and getting used to reporting to board members. All those things are going to put you in a really good position and make you more presentable as a company to investors later on. So, one of the hard things about doing this topic in a webinar format is that, I have to talk in kind of hypotheticals because the math gets a little bit complicated. But to make things a little bit easier for people, we have created a calculator basically that lets you compare what dilution looks like in your later rounds by modeling out a convertible note or a safe versus equity. So there are blocks in blue on that spreadsheet. If you go to carastone.com/calculator, you can enter in the applicable values and it'll do the calculation for you. So you can see, like, if I give a note with this valuation cap or I just give equity at this valuation, what does it look like for dilution for me and what does it look like in the next round? So I encourage you to go use that as a starting point to start thinking about the math behind this stuff. And I would say some of the other variables that you want to keep in mind as you're modeling out these things are what does your market or what does the overall venture capital market in the central US look like? So for example, I think you need to know your valuation multiple. If you're a revenue generating company, then any VC or sophisticated angel or seed group is going to assign some kind of multiple to your revenue, generally speaking. And I would say that, there's pretty hard data out there that suggests that for seed rounds, the average valuation is anywhere between 2.5 million to maybe 5 million at most. And then for Series A deals, and that's for companies that are doing $1 million more in annual recurring revenue, that number is probably between 6 and 20, depending on where you are. So you need to kind of know those things to make educated guesses about what your valuation is going to be. The number one mistake that I've seen in the last 10 years in the central US are people benchmarking their expected valuations and round sizes to what they read about deals on the East and West Coast. It's the number one mistake. When we see companies that are basically going out assuming that they're going to have a much easier time raising $1 million plus seed round, and then assuming that their valuation, their Series A, is going to be substantially higher than $6 million when they're either not revenue producing or they're not producing $1 million or more and growing at triple digit growth rates. When companies end up in that position, there is no way to make the math work for a Series A investor without completely recapitalizing and cramming down your note holders, which they typically don't want to do. So number one, know your valuation multiple. Number two, try to figure out the average and median round size. And I think you also need to be pretty familiar with what your expected milestones that you need to reach for your next round before you model out what your convertible note looks like. So for example, if you're a pre-product company, hopefully you know by now that your investments are either going to have to come from accelerator seed groups that are either impact focused or economic development focused, or they're going to have to come from people you know or meet. It's very hard to get investment from other professional groups if you're kind of pre-product, pre-revenue stage. If you're post-product or post-MVP stage and you're generating revenue, you're going to have to do a seed round, with the average check size probably being around $50,000. And so if you're going out trying to do $1 million note round and you have an MVP, I can tell you, you're probably on the wrong track unless you're just an extremely high performer and you have some history of success and you're able to generate that kind of interest in your round. For companies that are, between $20,000 and $100,000 in monthly recurring revenue, I still think that a lot of people consider that seed, and then your valuation is going to really be multiple, like some kind of multiple of revenue with some, more like artistic factors, for lack of a better word. So we do make some other resources available to companies on this because, again, I think financing strategy rather than execution strategy is one of the main stumbling blocks to people successfully raising money in these central United States markets. So I'd encourage you to go to vc.carastone.com. We track it for Missouri and every other state individually on what our average and median round size. We break it down by specific industry segments. If you contact us and we help you with your financing round, we can tell you what check sizes people write in your market, at what stages, for what kinds of deals. We can tell you the terms that they use too. So having that kind of information is the thing that separates the people from being in the 1% that get the venture capital funding and those that don't. So you got to do the math. So when do I really like notes? Well, as I mentioned, between rounds, they're oftentimes the best instrument or maybe the only instrument available. So, when you have a Series A company or a seed company that's doing something spectacular. Let's say they modeled out getting one big customer, and it turns out they're getting 3 big customers on board at once, and they really need to scale up to meet that demand. Well, there needs to be some kind of financing injection that happens pretty quickly. And oftentimes the best way to do that is going to be the bridge round, because there's going to be a lot of risk in that. Number 2, best reason to me to do a convertible note or a safe round is to incentivize investors and jumpstart a round. And we'll get into this a little bit more specifically, and then I'll turn over questions in a few minutes. But if you have a bunch of key people that you think are awesome, that are going to help you raise more money when you're syndicating around, by all means, if you should give them a better deal and then put their name on it, have them support the company, and that's going to make it easier for you to get other investors. But you shouldn't do that as your whole round. Example, if you're trying to raise a $500,000 seed round, you don't want to do a $500,000 convertible note or safe. Instead, consider doing $150,000 or $100,000 note round that's specifically reserved for that handful or 2 or 3 key people that are going to make the difference in the credibility of your startup. That can jumpstart a round and make it easier for you to start signing up Series C or Series A term sheets with other investors. So I think that's a key situation where you want to do that. Likewise, if you're having a little bit of trouble and you're saying, look, I know that you have something there, you're getting a lot of interest in the round, you can't convince people to do stuff. Oftentimes, by the way, the inability to convince people to sign on to any kind of round is because they think your valuation's too high. So number 1, consider reducing it to something that people will like better. And number 2, consider offering some key people a little bit better deal in the form of a discount and or valuation cap, which is what they get in notes. So again, remind you, just please do your homework on this and don't look at a convertible safe or a note, a convertible note or a safe as your round. You should view it as part of your equity round, because that's what it is. The assumption is that it converts over. So if you find yourself at Series A trying to convert $1 million of a convertible note instrument plus another $2 million in new money, your valuation is going to have to be very high to ensure that you don't sell too much company in that Series A. Otherwise, people are going to kind of second guess your choice there. So here's some more information about where you can find useful resources. VC@carastone.com. We love the digital ecosystem map. That's why we're a sponsor of that. And then the note versus equity calculator. And so I know I've gone through this pretty quickly, but I figured the best way to kind of help out and engage everyone is to answer any questions or further explain things or just listen to your feedback and tell me that you have a different experience. So I'll open it up to questions now. I guess I'll turn it over to Connie and the folks on how to do this, practically speaking.
Sure, no problems. Yeah. So if anybody wants to type in a chat, they're more than welcome to, or if you'd rather just speak up, that's fine too. Yes, we will get this video. Is that from you, Bronwyn? Yeah, we'll get the video and we'll get that out to everybody in a couple of days after. We get that from Venture Cafe, so we'll get that to you.
I don't see the chat box. I don't know if I'm doing something.
Do you see where the participants are, Mark? You see at the bottom where it's got participants? The chat should be right next to it. Like if you hover over the bottom of your screen, do you see that?
Yeah, I'm trying to maximize.
Okay.
Oh, okay.
Can you see it?
Sorry.
Okay.
Great. Good. We have a blog post on this.
Yeah, I've got that posted. I put your calculator up there, so I just threw a couple things in there.
I guess I'll say while people are maybe typing messages or thinking about stuff,
Yes.
I see a couple of things coming in, but let me just say, like, I definitely don't want to come off as anti-note, right? So to the extent I persuasively argued against the convertible note or the safe, I think it's because what I really would like to get out of this, if there's any message anybody takes away from this, it's that you just think critically about why you would use it and not use it, and put it in the context of your next round. Because I think sometimes, we're all tempted in life to do what's expedient for the moment without necessarily thinking about the down the road impacts of a financing strategy or other choice in life. So I think the key point is you just want to take a look at why you're doing the note, model it out, see if you can get an uncapped note. You know, a lot of what I'm saying I would maybe be okay with. So like, you know, what we were able to do, at least in the Louisiana market, when I got back from Silicon Valley, is get away from valuation caps for the most part, and just give the discount and the interest. And the idea basically behind all that, by the way, is that, you know, you're already giving someone an incentive to come in with an uncapped note in the form of that interest, which is an extra bonus on top of, they wouldn't get that for equity, and that discount. Those are two good rewards for the riskier seed deal or early stage deal. The valuation cap is an insurance policy and arguably is kind of unfair and then hamstrings you in your negotiation with the next investors. And I think the one thing you want to point out to investors that are asking for a valuation cap is is essentially saying that, you know, you're getting a good reward and your incentives, your equity value is higher the higher my valuation goes. It's not less. So don't handicap our negotiations. All right, now we've got some questions in there, so we'll all right, am I available for office hours? Yes. I'm glad you asked that question. I'm going to get some availability out. Hopefully I-10 can share that with folks, and I'm happy to do some sessions with people, help model out, think through strategy on financing and other issues, and give you feedback otherwise. So is YC the only accelerator that gives a SAFE? No, definitely not. So that, you know, the SAFE has been modeled all over the world at this point, and it's a very common instrument. So, you know, within the central US, there are several groups in Tennessee that do it. I don't know offhand which groups in St. Louis are doing SAFEs. I haven't seen that many, actually. There may be one or two accelerators that are doing that. David Weaver. Hello, David. Good to see you. He makes a comment, never use a YC post-money SAFE. It's worse than a full ratchet. So let's talk about that concept for a minute, because you know, some of this stuff is complicated, right? And I launched into all this assuming that people have kind of a background on the key features of a convertible note in a SAFE. So a couple key concepts that you need to be familiar with in any convertible instrument. Number one is the discount. And this answers Tom Daly's question, hopefully. So the discount is the discount to the price per share that you sell in your next equity round, all right? More often than not, I would say to the extent there are market standards, the market standard discount is 20% off the next price per share. So in other words, any money you invest under the note will convert into the equity that you sell to the next folks at a 20% discount. So to calculate it, it's 0.8 times whatever that price per share is in the next round. All right. So that's concept number one. Concept number two being the valuation cap, if it's applicable. So in all equity, in all startup financing, it's kind of crucial that you start using cap table models or otherwise doing stuff in Excel so that you find that price per share. All right. So a valuation cap is basically a number, and it sets the total limit through which people then determine the price. So an example, you say valuation cap is $1 million and you have 1 million shares outstanding. Well, your price per share is $1 million in your price per share is $1 in your next round is the best example of that. Our calculator helps you kind of understand these concepts a bit. So whenever you're reading a note or a SAFE, there are multiple ways that people write out the math about how conversion works. So in some instruments, they may say, they may calculate what's called a fully diluted capitalization number, meaning that the denominator, so the numerator is that $5 million, or the numerator is the number of shares outstanding. And some people say it's all equity outstanding at the next round, plus SAFEs, plus notes, plus equity financings. And then others might say it's just the number of actual shares outstanding, not including your option plan or other SAFEs or other notes. So, you know, this also kind of weighs against that argument that people use. Well, SAFEs and notes are just so much simpler. In fact, they're very complicated. And you know, you almost have to be a lawyer to figure out these different equations that are written in the conversion sections of these promissory notes and safes. And so some calculate it very favorably to the founders in the company, and some are very aggressive in how they calculate it. And so, you need to pay close attention to that. I think it's a little bit beyond the scope of this to get into those in particular, but I'd love to do a follow-up thing if people are interested in what the difference is between those. Okay, I got a question. I think this is a good one. A convertible note, safe investor, how does he or she perceive the risk? Is it same as an equity investor? My view of this I've done a lot of angel investing over the years, and now I get to wear a VC hat sometimes. I don't think for people that do this regularly, one is perceived as better. I'll tell you this, as an investor, I think safes and notes are better for me. So as an angel, I've definitely negotiated with companies. Well, I want a convertible note or a safe because I want a better deal than the next round. I think that my involvement and other people I might introduce you to is going to make it more credible and may help you. So I should get a better deal. I think there are a lot of angels and other groups that look at it that way. So in a way, the convertible note and the safe is investor favorable from that point of view. I don't think like the investor thinks that getting into the equity is more risky to them if it doesn't work out. That's kind of all the same. You're either going to make a multiple on your money or you're not, is kind of how it's looked at. And follow-up question there was, so is a convertible note safe investor basically getting the next round valuation shares at a discount by investing now? Yes, plus the interest. So you're hitting it. So that's the whole point of the convertible note or the safe, is to give someone two primary economic benefits: the interest and the discount to the price per share that the next investors pay. All right. The third, which is also a huge benefit and is either an insurance policy or just a straight up good deal for them, is what's called the valuation cap, which says that I'm going to convert at a price per share no higher than this, which is basically setting the price in their round for your equity. So,
Mark,
yeah.
I had a question about industry trends. I noticed from the participants, we've got a mix of those that are in the biotech space and, are working with either founders in that space or working with founders, and those that are launching more traditional tech software companies and those sorts of things, which, tend to have kind of different paths to commercialization, different timelines. Are you seeing anything different in how they're using these notes versus safes versus, the common, is it more common in biotech or less common, or does it matter?
That's a good question. I don't know that. I've never studied that. We have the data to pull that, I think, but I don't think my initial, so looking at all these markets, like as much as I do, I don't see, nothing jumped out at me to even think about that. But I do think that groups within those industries have certain proclivities for sure. Mm-hmm. I know that I've been pretty involved with the Angel Capital Association over the years in the Public Policy Committee. I know that a lot of angel groups are definitely fine with notes these days. A lot of organized angel groups do not like safes. Why? I think they're kind of the same instrument. I don't agree with that, but I do think that that's kind of, so I think it's more, groups get comfortable with certain instruments and certain things happening. Over the years, I've represented some more economic development or impact focused seed and other types of funds. And they're equally fine with safes and notes, for example. And they like doing it because we can set them up with a template and they like it. And you can kind of do a generic convertible instrument that works for an LLC and a corporation. I should note a tax issue there. If you are an LLC, number one, you might need to think about changing that because there are a lot of good reasons. I post on that for everyone too. But when you convert from an LLC to a corporation later on, which most companies have to do once they get into institutional venture capital, the forgiveness of convertible debt is treated as income to people oftentimes. So that's a kind of a negative thing. You need to be careful with the structuring. Safes are a little bit different. Most people believe that safes aren't treated as forgiveness of debt, although there is some uncertainty there. So yeah, I don't notice an industry difference, but I will go through and see actually, because it'll be fun to do. Thank you for identifying that.
Mark, I had a question from someone, Catherine Van She's asking if you can dive deeper or explain in more detail the phrase, know your expected valuation multiple.
Okay, yeah. So like I'm saying, once you're in revenue land as a startup, you start to be judged based on your performance and your revenue growth. And so if you're in software, you might see really high valuation multiples of anywhere from like 5 to 11 or 15x or more. If you are a consumer products good company, you might see it a lot lower, So each industry has kind of a revenue multiple if you're at the revenue stage. For pre-revenue companies or biotech companies, pharmaceutical companies, et cetera, it's a whole different kind of ballgame. Those are a lot different, and there are a lot of different factors based on milestones and what phase you are in clinical studies or what kind of path to clearance you might have. So that's a little bit different. And there's, I think, a more well-developed industry. It's almost like biotech and pharma is a little bit separate from like everything else, I feel like, these days. But when I say know your valuation multiple, what I really mean is know what your valuation negotiations are going to center over. So if you're a pre-MVP or pre-revenue company, your valuation is going to be a number that everybody just picks in that range of 10 to 33%. And it's going to be weighted based on your experience, based on the possibilities, where people think you might end up on revenue in a year or so from now. That's all going to factor into it. So what I see happening a lot in safes, and I think this is like some of the really good companies that I've wanted to fund over the years that I couldn't, at least as a VC or an angel, are the ones that, have picked a really high valuation cap. So it's like they knew the issue. They don't want to set the valuation cap too low, but they said they've raised so much money under a note that by the time, like, they'll have to do so many convertible note rounds before their first equity round, that their first equity round is going to sell more than like 50% of the company. So there's like a market for this stuff. And there are people like me and others that study it. And they say, well, for Series A companies, we're going to pay between this and that. And that's kind of what it is. So same with seed. And, there's good materials out there. So we have some good valuation reference points, but there's also, good angel resources out there. There aren't as many good Series A and beyond valuation data points for the Missouri market or for Louisiana or Tennessee. We are working on that. We have is probably as good a database as you're going to get on it. But I think that's part of the issue there is people just aren't sure where it's going to end up when they do their next round. So yeah, there's been some discussion in here about like safes don't have interest. That's true. So benefit over a safe is that they do not have interest for the most part. So a convertible note is like a debt. I mean, it is a debt and it has interest and it accrues over time and might compound, it might not compound. That's a negotiated point. I would say the number that people put in the box for the most part ranges at either 6 or 8%. That's the most common one that I see on a daily basis. And a benefit of a safe over a note, and this is one of the reasons why Y Combinator created it, was they said, well, everybody wants these things to convert anyway. They shouldn't really be debt. That gives the investors the right to take things over if it doesn't work out. That's not what anybody intended. That's true. And then, so we're not going to do interest. So you do see safes with either just a discount or a valuation cap, but then they get complex on how you calculate those conversion prices within the document. Let me see what else people are saying. I don't know. Let me see. How much do current economic conditions affect what instruments investors want to utilize? I think that's a good question. I mean, my perspective on this is that I wasn't doing that many note deals before the last recession. After the last recession, I mean, things went berserk with notes and then safes. So I think they're here to stay. And I think, again, my view of this, although I want to study this now, is like, I think that some groups have just made up their mind. Like, we like notes or safes at our stage. So I do see quite a few accelerators and early stage seed funds, a lot of times with an impact focus. I think that I could say pretty confidently that a lot of them have a default toward a safe. And it's kind of an equity agnostic safe. I feel pretty good saying that. I think it has less to do with economic conditions now than what the prevailing views are. Now, the exception to that is for existing portfolio companies of funds. I do still think that there is a preference for a convertible note. In the last recession, another thing that I saw in addition to convertible notes were kind of fair, considered like acceptable and okay. In these environments, and it's happening now, companies undergo recapitalizations. And that means like an investor might cram down other investors. They say, I'm going to fund this company, but if you can't step up to fund this round, then you're going to lose certain rights of your preferred stock. So you're seeing some of that now. You are also seeing, unfortunately, I'm always surprised with this, but you're seeing like, I think some groups, if a deal is very hot or competitive, I have seen some groups like shoot a note term sheet over while an equity term sheet is kind of in process. And one note of caution on that, you should be careful and still do the math, and you should definitely not assume you're going to close your convertible note round before the equity round. So if you're in the lucky position of having multiple investment groups suiting you and you get multiple competing term sheets, be careful not to burn bridges. That's a really important thing, because those deals sometimes fall through. And then by the time you get to the fine print of how these notes and safes are calculated, you might end up in a worse position. I've seen that happen a couple of times lately. So, if you are a company founder or working with a company, your goal should be able to build consensus. I've yet to work with a company that failed because they had too much money. I've only worked with companies that have failed because they couldn't access the next round. So you want to build a coalition of investors so that everything is fair, it's balanced, you have multiple people, points of contact. You oftentimes, want to try to get everybody in the round. So when are warrants used? Good question. It's negotiated. I haven't done a note and warrant deal in a long time. I bet I will do some soon with COVID. So that's another sweetener that investors will get to increase the economic value of their convertible note deal. I haven't done any safe with warrants deals personally that I can think of offhand. So warrants, just so everybody knows, a warrant is like an option to buy stock. So it's the right to buy stock at a predetermined price. And warrant coverage is basically a made up number that somebody comes in the deal and says X number of dollars of my investment gets me a warrant to buy some number of shares at some either nominal price like a penny or at some price per share everybody agrees to. So that's a way for an investor to get a little bit more impact. The effect of it is it drives your valuation cap down and it makes it more valuable. So think of it kind of like a loan commitment fee. If you went to a bank and they said, I'm going to charge you 10 grand for doing this loan in the first place, that's probably the way to think about a warrant in a way. So I think that covers most of the questions so far.
I think we got them all.
Yeah.
So any more questions from anybody? No. Okay. So yeah, we typed a few things in here. We'll get the recording out a couple days afterwards. And again, we want to thank Mark and everybody for joining us. And again, Cara Stone is like I-10's digital ecosystem map sponsor. We're very grateful for them for that. And make sure you check that out as well.
Yeah. And